time will tell with the vast majority of investors on the sidelines. Stepping in now is the right time. I think if we have a soft landing in the economy or a mild recession this year, or certainly no recession, it'll turn out to be a great time to buy.
Good day, Industrial Advisors listeners, and thank you for tuning in. If you have not subscribed, please do so by clicking subscribe wherever you podcast. Click the like button and hit the bell if you want notifications of when we put up new content. Leave us a comment about anything we discuss here today or general comments about the show. Now, let's get into it.
All right, welcome to our Industrial Advisors podcast. Today we have a client and a friend as our guest to talk about the U.S. capital markets. We have Paul White, who is a managing director at LaSalle Investment Management. And Paul, before we dive in, I got to say, we recently did a 5-Minute Friday on how awesome it is when good clients become good friends. And I think that tells kind of the story with you, our story with you, perfectly. You started out as a really good client, someone that we went after and have developed into an even better friend. So it is absolutely awesome to have you on our podcast, and really excited to have you on.
It is my honor, and it's a pleasure to be on with you guys. So great, looking forward to it.
Before we jump into the capital markets, tell us a little bit about your background in the commercial real estate space and how you ended up where you are today.
Well, maybe like a lot of us in the real estate field, I was grinding my way through state university and, excelling in not getting many, great grades and things like that. But I did, senior year, I took just a principles of real estate class and found it interesting. And then the second semester, took a real estate investment class. I'm like, this sounds like what I want to do. So I spent years in the trenches before kind of making it up to the national investment world. I was a industrial broker in Chicago, working on very non-institutional, down and dirty industrial real estate, knocking on doors, handing out flyers, trying to get listings, do lease deals, sell small buildings, maybe sell a land site here and there. And then after about I'd say 6-7 years of that, I went to DePaul University downtown Chicago for my MBA. That was 3 years of night school, again, grinding through.
That's grinding right there.
Got out early 90s, knocked on a bunch of doors. They weren't swinging wide open. So I worked for an appraisal company for 2 years and, built the models and underwrote assets across the country, all different property types. And from there, I kind of parlayed that into getting in the door at LaSalle. And I've been at LaSalle since December of 1995, doing industrial acquisitions for the vast majority of that time. So,
And currently you're just doing industrial acquisitions?
Yeah, I've done just that's really all I've done, Matt, since 1998, probably. So my territory's expanded over time, but I'm based in Chicago, but I cover Chicago out to the West Coast. Most of our activity is up and down the coast and a couple inland markets. But I buy existing buildings. I also form development joint ventures. So both aspects of the business there.
Yeah. What I think is cool, Paul, is, right now when a lot of folks are on the sidelines, you guys have bought some really, really strategic Class A buildings here, and you bought one in our market in Renton that is one of the better buildings in our market, and so I think you're gonna look back on that, and that's gonna be a great buy.
Yeah, we hope. I mean, it's always interesting when the vast majority of buyers put their pencils down. We did that in March of 2020. We put our pencils down and thought, look out, this is a 100-year event, what's going to happen here. But we picked them back up in August of that year. And as you guys know, the industrial market was, supercharged from COVID. Yep. Now it's, there's various reasons why a lot of buyers are on the sidelines. Time will tell. You never really know in the moment, but time will tell if, with the vast majority of investors on the sidelines, stepping in now is the right time. I think if we have a soft landing in the economy or a mild recession this year, or certainly no recession, it'll turn out to be a great time to buy. If things really go south, then property values will fall. But on that, really, I would say all that's really trading right now is that, really high quality Class A, mostly fully leased, empty shells. People stopped doing those relatively early in 2022. So it's a small number of buyers, but it's a small number of assets that we buyers are willing to move on right now. So.
Well, the fact that you and LaSalle are picking up your pencil tells me other people should consider it, because I've never seen you make anything but wise real estate decisions. That's for sure.
Deal with a downturn. Remember the deal with a downturn? Yeah.
Yes, sir.
I got some very good advice from some brokers that said in the summer of 2010, go ahead and buy that building that, gosh, I don't know, it declined 30, 40% in value, but 2010 was early coming out of that global financial crisis. But I had
that's right.
wise counsel from a couple fellows on the call here that really helped us buy early in that cycle. And that did, we weren't the only ones. That buying early in that cycle proved to be, extremely attractive.
I think the land square foot price of that, where that building is more than per square foot what you paid for it in 2010. And I'm not kidding.
Yeah, it was low 40s a square foot for
that's insane.
A 250,000 foot building or something like that. Yeah, we should get into that. What's going on with land and rents and building values and all that? It's really been dramatic.
It has. Well, let's back up a little bit, because man, we came out of about a year ago, the hottest, most aggressive buying market, low cap market that we've ever seen.
I think where we're going is, Paul, where we are today. From where we, a year ago, we were at record cap rates and everything. And here we are, today in a different market. Where do you see things heading, throughout the rest of this year?
Well, first we should acknowledge what's happened in the last 12 months. It's been dramatic, right? Cap rates, pricing, rent, all that was, strong throughout the cycle, into 2019. Things were slowing down a little bit in 19, and then COVID hit, and then coming out of that, as I said before, that really just really had a dynamic impact on industrial demand, and the capital markets followed for it. So, but yeah, the peak in values is probably December of 21, January of 22. It happened pretty quickly. I would say by April, May of last year, we were already looking back at our buys early in the year and like, oh boy, here we go. So definitely a change. We can talk about the price declines and kind of what we think happened in 22. But as far as 23, I personally think most of the value decline has already happened. And it happened in 22. And just simple math I like to do is, if something was a 3 cap a year ago and it's a 4 cap today, all else being equal, that's a 25% decline. And I think sitting here today, I think most market participants would say, yeah, cap rates have moved up more than 100 basis points. Probably 100, 125, maybe even 150. And just that cap rate number, as that's when I say that, that's assuming something is leased at market. Obviously, there's buildings that are leased at 10% below market, 50% below market. But I think the cap rates have moved, 100 to 150 basis points on the coast. They've moved more than that. They're for inland U.S. markets. The good markets, Indianapolis, Columbus. These are markets that were low vacancy. Investors are piling in there for, high 3 cap rates. Those have moved 175, maybe 200 basis points. So the move has been dramatic, and it hasn't been reflected yet in whether it's, institutional funds or even the non-trader REITs, and probably even with a lot of lenders, they haven't marked what their true loan to value is now. But it's happened. Everyone knows it's happened, and the handful of trades that are happening or have happened show how much values have declined. So I think for 2023, I think the majority of the decline has already happened. I think it's going to be pretty quiet the first quarter or two. I think the people that have their pencils down, I don't think they're picking them up right. I mean, there's been no change, right? It's just a continuation of the fourth quarter of last year. Everybody's waiting to see how high interest rates go. Do we enter a recession? If so, when? What does inflation do? We get the inflation numbers every month. So, as though the more those come down, the more bullish people will be, and the less likely the Fed will, keep cranking the rates up. But all that has to play out, and we're, it's the 11th of January, so it's going to take time. So I think it's going to be kind of slow on the transaction side, capital markets wise. Certainly the first quarter, maybe the first half, and then second half is depending on what happens in the first half, really.
Now that's market wide, but what about LaSalle? Because you guys are buying. So is this a time that you think is super strategic to get in there and bulk up a bit?
So at LaSalle, just so the listeners know, I mean, we've got internally managed funds. We have separate account clients, which are typically like state pension funds or insurance companies. So we've got a variety of clients, and each with their own strategy. I mean, most of them, hire LaSalle to, affect their strategy. And in many cases, we're picking the strategy, but still, development funds, aren't doing anything right now.
Mm-hmm.
So it's kind of complicated. It depends on the client, not just the advisor like us, but on the client, on do they even have money right now? It could be an insurance company that's saying, wow, I've got a lot of liabilities. I had a lot of losses in 22. I'm seeing really good returns now that I can get in the bond market. So let me reallocate some money from real estate to bonds. So a lot of it is, so we made the investment that you're talking about in Renton. We've made a couple others. We made another one in Seattle. We're making one down in Southern California. We've done a couple others. Those it hasn't been a LaSalle-wide strategy to bulk up. It's more, we've got some money from a couple of our clients, and we think it's a good time to buy because the prices are down. So,
right.
Yeah.
It's interesting, Paul, because I agree. I think the investment side is going to be really slower, I should say, the first half of this year, and then people start getting after it again. But the fundamentals, when you look at the leasing fundamentals, and our market's a perfect example, right? We're 3.5% vacant.
Mm-hmm.
It is definitely a landlord's market. There's a lot of tenant velocity. And so the fundamentals are really strong here. When I started in the business 20 years ago, it was a really good thing on the investment side to have a long-term lease in place. 10-year, the longer the lease, the better, right? For stability.
Yeah.
Now,
Yeah.
Obviously investors have shifted their mindset given the industrial fundamentals, and shorter term WALT is looked upon more favorably than longer term leases. How do you guys look at that right now? Would you rather have stability? And it probably depends on the fund and everything, but how do you look at weighted lease term right now?
Yeah, that's a good question, and it does depend on the fund for sure. So let's go back 12, 13 months. Let's say December of 21. The 10-year Treasury was around 1.7.
Mm-hmm.
Lenders were really aggressive, so you could get 10-year money at 110, 120 basis points above that 1.7. So you could fix long-term debt 2.8, 2.9, 3%. Let's call it 3%. So if you could go out and buy something, say at a 3.5% cap, and it was going to grow, and it was long-term lease, a positive leverage, that was a great investment. Now, but even back then, that would be considered a conservative investment, slow and steady. There's always some funds or some desire within certain funds to have some level of stability and also some growth. I think the desire, anyway, to finish on that, now, obviously, the 10-year got up to 4.3 in October. It's around 3.5, 3.6 now, but the spreads have widened quite a bit. So you try to get that same 10-year money, and you're going to be in the high fives. Meaning what? Meaning you got to go out and find an investment that ideally, yields in the high fives to start. So you've got some positive leverage and it only grows. Well, guess what? You're not going to buy a high quality long-term leased asset at a high fives cap rate. Certainly not in the coastal markets where that was 3% a year ago. I mean, nobody's going to sell at those numbers.
That's right.
But I think the desire for the short-term wall, I think that's really driven by rent growth. Rent growth has been dramatic, as you guys know. Markets like Seattle and LA, I mean, LA has led the pack, but all across the country. I mean, middle of the country markets, growth markets like Phoenix, Vegas, rent growth has been dramatic. And why is that? I mean, the vacancy rate, I'm just looking, Colliers has the national vacancy rate at 3.7, Cushman 3.3, CBRE 2.9. So call it 3% plus or minus. That's a really low rate. You guys might know better than me, but at what point in a vacancy rate in a market does it flip over and become a landlord market where it's like, I was asking, whatever, 50 cents a foot, but why don't I ask 60 cents a foot? Why don't I just increase my asking price 20% just because I'm looking around and I'm not seeing much competition? So the rent growth has been so dramatic that if you can buy something today and the lease rates are, you name the percentage, 10% below market or 50% below market, the sooner you can roll that up to market, the better. So that's, instead of taking a long-term lease, say at 4.5%, it's going to grow steady. Why not buy something at 4.5% that you think in 3 years, you might be at a 6%. So that's the attraction for the short-term walls. There's risk with that. There's risk that goes with that. What if it's a bad time to try to renew those tenants? What if we do go in a recession in the second half of 23 and tenants start giving back space, and all of a sudden that rise in rents that you thought you're going to get, now all of a sudden you're begging the tenant to stay in place. So there's risk with it, but like you said, Bill, the fundamentals are pretty good. Vacancy rates pretty low. It'd take a pretty dramatic increase in vacancy rates before you wouldn't feel good about having rollover coming in the next few years.
So Paul, that's a great point on the short-term wall and why people like it. Talk to us about why forwards have disappeared. If short-term walled is good, wouldn't a forward, which is, you're acquiring a vacant building that's under construction, that market has completely eroded. That was a hot market for several years. And then about 10 months ago, that disappeared. Why?
Yes. Yeah. I think, some of that could be financing. I mean, some of it could be, hey, I'm going to lease this and I'm going to put a 50, 60% loan on it. And loans for construction, loans for vacant buildings, good luck trying to get it. So when the debt market pulls back, the equity market has to take note, even if it's, we've got funds that are all equity, they don't use any debt. Still, you're looking at saying, okay, if a lender happened to make a loan on this building and they would get a, low risk 50% of value and they're going to make something in the fives, what am I gonna pay for it? So the required going in yield and total return, just increased pretty dramatically as 2022 unfolded. So the requirement for return change, meaning that value's got to, of what you buy has got to go down. The availability of debt largely dried up, so that's got to affect you. And lastly, just in the equity or bond markets, they talk about risk on, risk off. I think it's pretty early in, by the second quarter of 2022, it became risk off. And risk off meant not only I got a vacant building to lease up, yes, the fundamentals remain strong in 22 and still are for the most part. But, if it's a forward, say it's April of 22 and you're going to commit to something in December of 22, you're thinking, how do I know what the market's like by then? So it's just the combination of those three factors, I think, change things. And just, you think just the change in cap rates. So think of, let's just pick any coastal West Coast market. It could be Seattle, could be whatever. But if you think, hey, the core Class A leased assets 12, 13 months ago was 3 to 3.25 cap, and all this capital for product. So you were willing to buy an empty building for, say, 3.5, 3.75. Hey, I'm getting a 50, 75 basis point premium. Well, as those, the 3 to 3.25 no longer existed by the middle of the year, so your yield goes up. Rents did still grow. In hindsight, you look back, they grew in 22, but you didn't know that when you were going to commit. Construction delays. I mean, we committed on a forward in Las Vegas, I think in March of last year. It was supposed to be done in December. It's going to be done in April. That turns out the market's still strong, but still just all that uncertainty.
For sure.
It means just risk off. If I buy it, first of all, most buyers saying, I'm not doing anything. The buyers that say, if I do something, I'm going to buy a good building that used to be, $400 a foot, and now it's $320 a foot. That's what I'm going to do in this environment.
So we saw a lot of changes, to your point, in this year, maybe the most changes in 1 year since maybe 2008, and maybe more than 2008. Yeah.
Predictions for 2023.
Okay, yeah. So I mean, I touched on that a little bit. I think the majority of the decline has happened. So if you say Seattle's gone from a 3 to 3.25 to 4.5, maybe. I mean, that's anybody's guess, but and other markets have gone from 3.75 to 5.25, 5.5. So those moves have taken place, and really repeating myself, but the best stuff is what's trading right now. Class A assets, fully leased, probably a shorter WALT, so I can get that yield up. That's all that's really trading. There's a lot of stuff that, either brokers brought out in the second half of last year that just didn't trade, or things that just aren't being brought to market. So, so my prediction, with a little bit of hope mixed in there, is that most of the decline has happened. We see as the year unfolds that if there's a recession, it's mild. The fundamentals kind of pushing industrial, safety stock and low vacancy rate and bringing the product closer to the consumers, all that still holds. And, we come through it relatively unscathed. But I saw one of the national brokerage firms said 2021 was the highest net absorption ever. That makes sense. 2022 was the second highest.
That's right.
And they were predicting that 2023 would be the third highest. If 2023 ends up being the third highest, you think, gosh, all those years back, 14, 15, 16, like those are good years, right?
Yes.
I mean, if we can do that's a home run. So
absolutely.
So maybe, I don't know, 60, 40, 70, 30, that's what happens. Obviously, the risk is there that the recession turns out to be deeper than anybody wants it to be. Inflation is more stubborn than anybody wants it to be. Interest rates go up higher than, all that could happen, and that, that'll affect demand at some point. It infects enough business owners' mind of where I just got to sit tight with the space I've got. I'm not taking any new space right now. So I think, better than 50% chance that it's a good operating fundamental year. Slow capital markets. 2024 should be a lot better on the capital market side.
Excellent. Well, Paul, it's been a long time coming to have you on the show. You're, as Bill introduced you, certainly a great friend of ours and a great client. Somebody we have a lot of respect for, one of the best acquisition guys in the country. I want to thank you for being on the show. Had a great time with you. Appreciate you being on our show today.
Thank you very much, Bill, Matt. You guys are the best. And with those kind words, Matt, I'm glad your microphone was working.
Sorry about the technical issues.
That was
You
nice
got a
to
lot
hear.
of build today.
Yeah, that's right. Which we think is probably a good thing for ratings. Yeah. They call it the Bill and
Yeah.
Paul show. We could start
Yeah.
our own one. We can kick Matt off.
That's right.
Yeah,
If this is the number one rated show, I'm in a lot of trouble, Paul. I might be out of a podcasting job.
Three's a crowd, Matt.
That's
So,
right.
just saying.
Paul, thanks a lot, man. Really
Thank you,
appreciate
fellas.
you. All right.
Yeah, really enjoyed it. Thanks, guys.
Thank you.
Thanks a lot.